Hello learners, I am Dr. Naveen Tiwari, Associate Professor, School of Computing, Graphic Era, Hill University, Bhimtal campus. In the last lecture, we were discussing about recognizing and avoiding financial scams. And in this lecture, we will see secure investing in the digital age. Our learning objectives are to understand digital investing, to understand secure investing in the digital age, and to understand financial inclusion. What is digital investing? Digital investing refers to the use of digital platforms, tools, and technologies to manage, buy, sell, or monitor financial investments. It enables individuals to access financial markets and the investment opportunities through the internet or mobile apps without the need for traditional financial intermediaries. Key features of digital investing: online platforms, access via web based protocols or apps like Robinhood, Zerodha, Coinbase, etc. Low or zero commission reduces entry barriers for small investors. Automation. Robo advisors offer algorithm driven investment recommendations. Real time data. Investors can monitor markets and portfolio instantly. Diversified instruments, stocks, ETFs, mutual funds, cryptocurrencies, etc. Why cyber safety matters in the digital era? As investing increasingly moves online, the importance of cyber safety becomes critical to protecting both personal wealth and trust in the financial system. Growing cyber threats, increased digital exposure, financial exclusion, losses can be devastating, and cyber safety is the trust in the system. This is why the cyber safety matters in the digital era. The need for financial inclusion. Financial inclusion means making affordable, accessible, and secure financial services available to everyone, especially underserved and marginalized population. In the digital age, this is more vital than ever. Billions still lacks access to financial inclusion. Like 1.4 billion people globally remains unbanked. This is the information from World Bank in 2021. Many rely on cash-based systems limiting growth and security. Pathway to economic empowerment. Access to saving, credits, insurance, and investment allow people to build assets, start businesses. Inclusion promotes equality. Financial exclusion reinforces cycles of poverty, gender inequality, and social injustice. But inclusion must be secure. Vulnerable users are also easiest to exploit. Who is excluded today and why? Despite advances in digital finance, millions remains excluded from secure investing and financial services. Understanding who is left out and why is key to designing inclusive secure system. Now the commonly excluded groups are rural populations, low income individuals, women and girls, elderly or digitally illiterate, people with disabilities, and refugees and undocumented individuals. This is because of lack of access to infrastructure. No internet, mobile coverage or electricity, few or no local bank, ATM, etc. High cost or minimum requirement, high fees, minimum balances or investment threshold, lack of affordable financial products is also the reason to exclusion. Lack of legal identity or documentation, low financial or digital literacy. That is, users don't understand how digital investing or cyber safety works, fear or mistrust of online systems. Cultural and gender barriers. Social norms may restrict women's access to finance, language, and UX barrier for minority groups. Now, what is financial inclusion? Financial inclusion refers to the process of ensuring access to essential financial services such as savings, credit, insurance, and payment system to all individuals and businesses in a fair, transparent, and affordable manner. It aims to provide financial products and services to the underserved and unbanked population, particularly low income groups to enable them to participate effectively in the financial system. Principle of financial inclusion: accessibility, affordability, transparency, financial literacy, technology driven solutions, consumer protection, inclusivity, and sustainability. It is the principle of financial inclusion. Now, financial services should be easily accessible to all segments of the population, including those in remote or rural areas. Financial product must be affordable, with low or no fees for basic services to encourage widespread usage. Clear, concise, and easy to understand information should be provided about financial product and their terms and conditions. Educational initiatives should be implemented to equip people with the knowledge to make informed financial decisions. Utilize digital platforms, mobile banking, and fintech to reach undeserved population cost effectively. Safeguards should be in place to protect consumers against fraud, exploitations, and unfair practices. A special focus should be given to marginalized groups, including women, the elderly, and the person with disabilities. Now, the financial inclusion initiatives should be sustainable, ensuring long-term access to financial services. So, these are the principle of financial inclusion. The role of technology in expanding access to financial services. It is very important. Digital banking, mobile banking apps, and online platform provide convenient access to financial services without the need for physical branches. Blockchain and cryptocurrencies. Blockchain enables secure and transparent transactions, reducing frauds and increasing trust. Cryptocurrencies provided alternative payment system, especially in region with unstable banking infrastructure. Biometric identification. Biometric systems like fingerprints and facial recognition simply account creation and reduce frauds. Example, Aadhaar enabled payment system in India. Data analytics and AI. AI analyzes customer data to access credit worthiness, enabling microfinance and leading to individuals without formal credit histories. Agent banking and POS terminals. Banking system equipped with POS, that is point of sale devices, extend financial services to rural and remote areas. Internet and mobile penetration. Increased internet access allow for digital financial education and literacy program, expanding financial awareness. RegTech and compliance. Regulatory technology ensures compliance with financial regulations, promoting safe and secure transactions. Now, mobile banking and micro investing enhancing finance inclusion. Mobile banking involves using smartphones or other mobile devices to access banking services such as transfers, payments, saving, and account management. Now, key feature of mobile banking is account management, fund transfer, bill payments, mobile wallets, and remittance. Benefits of mobile banking: reduces the need for physical bank visitors, offers 24 by 7 access to financial services, enables quick low cost transactions, provides financial services in remote and undeserved areas. Now, the challenges faced by mobile banking are data privacy and security risk, digital literacy gaps, and network connectivity issues. Micro investing means the micro investing allows individual to invest a small amount of money in financial markets, making investing accessible to people with limited funds. Key features of micro investing: fractional share investment, automated savings and investment, user friendly mobile apps, portfolio diversification with small investments. The benefits of mobile bankings are low entry barriers for beginners, encourages savings and investing habits, provide exposure to financial market, facilitates wealth accumulation over time. And the challenges faced by mobile banking are potential for low returns due to small investments, lack of financial literacy can lead to poor investment choices, fees can erode returns for small scale investors. Now, digital wallets for unbanked. What is our digital wallets? Digital wallets are mobile applications or online platforms that enable users to store, transfer, and manage money electronically without the need for a traditional bank's account. Example: Paytm, M-Pesa, Alipay, and PayPal. How digital wallets support The unbanked. Financial access provides financial services to people without formal bank account, reduces dependency on cash and informal financial systems, accessible through basic smartphone and feature phones, simplify transactions such as payment, remittance, and utility bills, low or no transaction fees, making financial services affordable, eliminates the need for physical bank branches, transactions are traceable and protected through encryptions, reduces risk associated with carrying cash. Government disbursement and subsidies can be delivered directly to digital wallets, facilitates microloans and microinsurance for undeserved populations. Challenges in implementing digital wallets for unbanked. There are many challenges like digital literacy, network and connectivity, data privacy and security, and regulatory compliance. Barriers to financial inclusion, literacy, access, and trust. The first one is financial literacy. The ability to understand and effectively use financial products and services. Challenges: lack of awareness about banking, credit, and investments, limited understanding of digital financial tools, inadequate financial education programs in rural and undeserved areas. The impact of financial literacy are: increases vulnerability to fraud and scams, limits access to loans and credit due to poor financial management. Access to financial services. The availability and affordability of banking and financial services are known as access to financial services. Challenges faced by accessing is insufficient banking infrastructure in rural areas, high transaction costs for low income individuals, limited access to mobile network and internet services. Impact of access to financial services. It excludes marginalized population from formal financial systems, forces reliance on informal financial services with higher risk. Trust in financial system. The confidence that individual have in financial institution and digital platform is known as trust. Challenges faced by trust in financial systems are: previous experiences of frauds or service failures, concerns about data privacy and security, lack of regulatory framework and emerging markets. Impact: inhibits adoption of mobile banking and digital wallets, promotes cash based transaction over digital solutions. Now, financial inclusion for women and rural population. First one, financial inclusion for women. The barriers for women are: limited access to financial services due to cultural norms and gender discrimination, lower financial literacy rates compared to men, lack of property rights and collateral for loans, restricted mobility and digital access. Strategies for including women: tailored financial products like microloans for women entrepreneurs, digital literacy programs targeting women centric saving and investment schemes, mobile banking and digital wallets to overcome mobility barriers. Impact: empowers women to manage finances independently, encourages entrepreneurship and income generation, reduces poverty and promotes economic stability. Now, rural population and financial inclusion. Barriers are: lack of banking infrastructure and ATMs, poor internet connectivity and mobile network coverage, high transaction cost for small value transactions, limited awareness of financial products and services. Strategies for inclusion are: agent banking and mobile money services to extend reach, subsidized financial products tailored to rural income patterns, financial literacy programs in local languages, partnership with community organization to build trust. Impact: provides access to saving, credit, and insurance in remote areas, encourages small scale entrepreneurship and agriculture investment, mitigates financial risk during emergencies. Now, cryptography as a financial inclusion tool. Why cryptography for financial inclusion? Cryptocurrency provides access to financial services without requiring a traditional bank account, making them particularly valuable for the unbanked and underbanked population. It is decentralized, accessible to everyone, secure, and it provides financial empowerments. Benefits of financial inclusion. First one is economic growth. It increased consumer spending. Access to financial services enable people to save, borrow, and spend, driving economic activity. Microloans and microfinance empower small businesses to expand operation. Job creations. Financial inclusion foster entrepreneurship, leading to job opportunities, particularly in rural and undeserved areas. Formal economy integration reduces reliance on informal lending and unregulated cash transactions, boosting tax revenues and economic transparency. Now, benefits of financial stability. Risk mitigation. Access to saving accounts and insurance reduces vulnerability to financial shocks such as medical emergencies or natural disasters. Credit access. Credit facility provide a safety net for low income individual during economic downturns. A stable investment channels. Investment product enable low income earners to accumulate assets and build wealth over time. Social and economic empowerment. Empowering women. It provides financial services by enabling them to save, invest, and managing financial independently. Access to microloans foster females entrepreneurship, reducing inequality and community development. Digital frauds and scam are growing concern in financial inclusion. What is a digital fraud? Digital fraud involves the use of online platforms, digital payment system, or electronic communication to deceive individuals or organizations for financial gains. The common forms of digital frauds are phishing, spoofing, identity theft, SIM card swapping, fake investment schemes, and unauthorized access to digital wallets. How digital fraud affect financial inclusion? It erodes trust. Frequently, scams discourage people from using digital financial services. It also forms financial losses. Low income individual may lose critical saving, pushing them further into poverty. And regulatory backlash. Increased fraud can lead to stricter regulation, potentially restricting access to financial services. Now, what are common scams targeting the unbanked and underbanked? Mobile money fraud. Scammers impersonate mobile money agent to trick users into sharing pins or transferring funds. Loan scams. Fraudsters offer fake loans with upfront fees or access to personal information. Phishing attacks. Fraudsters send deceptive messages to steal login credential or personal data. Now, strategies to mitigate digital fraud. User education, strong authentication, transaction monitoring, and regulation and oversight. Financial literacy program to raise awareness about common scams and secure transaction practices. Implementing biometric verification and two-factor authentication. Real-time monitoring and fraud detection system to identify suspicious activity. Collaboration between financial institution, regulators, and law enforcement to enforce stringent cybersecurity measures. Now, fake apps and Ponzi schemes. What are fake apps? Fake apps are mobile or online application designed to look like legitimate financial services, but their primary goal is to deceive users into providing personal information, transferring funds, or installing malware. Types of fake apps. Fake banking app. App that mimic the look and feel of genuine banking app to steal user credential like username and password. Example, fake app offering banking features but only collect login data to access real bank accounts. Fake mobile wallets. Fraudulent app that claims to provide wallet services or reward programs but exist only to steal funds from users' account. Investment fraud apps. Apps that promote too good to be true investment scheme and defraud users for their savings. How fake apps impact financial inclusion? Loss of trust, financial losses, and barriers to adoption. Users who fall victim to these scams may lose confidence in digital financial system. Victims of fake app may suffer from financial thefts and fraud, often leaving them in worse financial condition. Fear of fraud prevents new users from engaging with digital finances, especially in undeserved communities. Now, Ponzi scams. A Ponzi scam is a type of investment scam where returns to early investors are paid using the capital of new investors rather than generating profits through legitimate business activity. How Ponzi scheme works? Initially, promise. Fraudster attracts victim with promises of high guarantee returns on investment with little to no risk. Payment structure. Early investors receive payments which may seem legitimate creating the illusion of a profitable business and collapse. As the scheme grows and new investment slow down, the scheme collapses because there is no actual profit being generated and later investors lose their money. Types of Ponzi scheme and digital platform. Online investment platform. Fraudulent website or mobile app promises high returns in sectors like cryptocurrency, forex trading, or real estate but are designed to steal funds from new investors. Scammers use social media and influencer marketing to promote fake investment opportunities that encourages followers to join Ponzi schemes. Impact of Ponzi schemes on financial inclusion. Financial losses, erosion of trust in financial systems, and regulatory stance. These are the impact of Ponzi schemes on financial inclusion. Victims, often from low income background, may lose life saving, leading to financial instability. Ponzi schemes undermine the credibility of legitimate financial services and digital investment platform. Ponzi schemes put pressure on regulators to create stricter policy, which can advertently limit access to legitimate financial services. How to protect yourself from fake apps and Ponzi schemes? For fake apps, download only from official stores, verify the app's authenticity, check for secure connections. And for Ponzi schemes, research before investing, watch for unrealistic promises, and report suspicious activities. Now, the learning outcome of these are: we understand digital investing, we understand secure investing in the digital age, and now we have knowledge about finance inclusion. In the next lecture, we will discuss more about secure investing. Thank you.